Shares of Procter Gamble, we've been tracking those this morning. They took a tumble following its latest earnings release. P&G posting a slight miss on its profits as sales volumes declined and higher prices of its products weigh on consumers. For more on this and the state of the consumer and consumer staples, let's bring in Peter Grom, who is the UBS U.S. household and personal care analyst. Great to have you here with us this morning, Peter. I want to get your take, first and foremost, on this earnings release from Procter & Gamble, and notably on the volume decrease there, especially given some of the pricing mechanisms that the company had to roll out.
Yeah, thank you for having me. I think what I would say is this quarter, had some good and had some bad. I think, on the initial reaction, the minus 6% volume was a bit disappointing, certainly versus our expectations and also versus street expectations. However, we felt the company did a very good job on the conference call this past hour, outlining the reasons behind that. First and foremost, they outlined, Russia, which was a 100 basis point impact. And they also discussed, inventory destocking at retailers. In other words, shipments are not matching consumption, which was another 200 basis point headwind to volume. So, on a like-for-like basis, the volume of minus 6% is more like a minus 3%, which would have been closer to our expectations. And so I think at the end of the day, consumption remains strong and not as bad, and elasticities are holding up better than we would have anticipated.
Peter, you mentioned being on the call and listening in. Give us a sense of the tone on the call and what you would recommend to investors who have either been tracking P&G or might be investors in P&G, given that tone that you're taking away from what executives are seeing going on throughout the rest of 2023 in the consumer environment right now?
I think it's a mixed bag. In the United States, the tone was still constructive. Consumption remains strong. The pricing environment remains favorable. Procter & Gamble discussed, the intention to take more pricing. I think, in emerging markets, places like Latin America, trends still remain strong. I would say, the two, key watch points would be Europe, which they pointed to some softer demand given the macro weakness there. And I think just the uncertainty on China. The company is expecting a more gradual recovery, but the visibility and the uncertainty remains. And I think that will kind of dictate, those would be the two key watch points, I would say, looking ahead.
Did you get a sense on the call that the management there feels that inflation has finally peaked, maybe goods inflation going to see that big decline this year? And I'm just wondering if they were concerned at all about labor costs. Now, they're not going to be concerned about that from the same standpoint as a services business, of course, but just wondering how these two components of inflation are interplaying in their outlook.
Yeah, so the company actually provided an update on their commodity inflation, which moved down marginally by roughly $100 million. Now, it's still quite substantial on a year-over-year basis, but it has moved down sequentially, probably for the first time in 2 to 3 years. So the company discussed on the conference call that they are starting to see input costs moderate. They highlighted pulp, resins, et cetera. So that they are starting to see the cost trend in the right direction, but there are still other costs that remain sticky. Labor might be one of them. And in addition, there's other supplier costs that they are dealing with that remain elevated. So I think things are trending in the right direction, but there's still the magnitude and pace in which costs can moderate is still a bit uncertain.
We had on Matt Maley a couple weeks back, I believe it might have even been last week, who had said that if consumers are clearly opting in for prices on discounted basis, then that would tell you that the consumer is not as healthy as what some banks and what some consumer staple companies may even be saying about the consumer, because they're accepting product at lower price. And so with that in mind, for the consumer of a company like P&G, when can they expect a normalization of prices?
Yeah, that's a great question. I think the thought process moving forward is that while they still are going to take additional pricing in certain markets where it warrants additional pricing, particularly around FX related pricing, I think you're starting to see a normalization in pricing moving ahead. We are going to start to lap the outsized high single-digit increases that we've seen in this sector, as we move into the back half of the first quarter and into the second half of this year. So that will be, we would expect pricing to moderate. That's what we are forecasting more broadly. I think the key question moving forward is what happens with volumes. We've seen volume elasticity hold up better on the way up. The question becomes, will volume growth resume as the year-over-year rate and pricing increases lessens? And I think that's kind of the one point of uncertainty as we think about category growth as we look out to the back half of the year. And I think Procter Gamble on the recent earnings call basically outlined that they expect category growth to moderate, largely because pricing will become less of a driver moving forward.
And just thinking about some of the categories here, just noting that grooming organic sales grew by 0%. I noted that earlier in the show. Just wondering if there's any color you can add there. Maybe it was discussed on the call. That and also baby feminine and family care organic sales missed expectations by a little bit. Any thoughts into what we can expect with those couple categories going forward?
I mean, so grooming, it's a wide range of product categories, and within that, you certainly have the everyday use function of the category, but you also have more of a durable nature in terms of razors and electronic razors and things of that nature. That's likely what we were seeing in terms of weakening demand in some of these categories where consumers are maybe extending the purchase cycle of some of these products. In baby fem care, the company has been dealing with some supply chain issues in fem care, so I think that has more to do with it than necessarily an indication of around where demand is going.
Peter, just lastly, while we have you, we only got about 30 seconds here, but are there any winners on an outsized basis that you look at within consumer staples right now from a stock performance perspective, and where do you place some of those expectations even with the consumer environment that we've been discussing?
That's a great question. I think from a sector perspective, this is really going to come down to what happens from a macro perspective. And I think within that context, if we are, in fact, heading for a recession, history will show us that consumer staples will outperform both heading into and during. And so I think it's going to be more of a broad-based group call. However, what I would say is that there's some things that have moved more favorably. I think, commodity costs moving lower is certainly a benefit. And I've also would highlight the weakening of the U.S. dollar. So I think companies like multinationals could potentially benefit here. And I think companies that have seen significant margin contraction, like a Colgate, could stand to benefit as we look out to 2023.